Tesla stock is currently trading at $480.97 USD, showing a decline of 4.59 points, or about 0.95% during today's session on this Wednesday, December 24th, 2025. While the broader market might be winding down for the holiday break, the activity around this specific ticker is anything but quiet. Most investors looking at their screens right now see a minor dip and assume it is just typical end-of-year profit-taking, or perhaps a bit of tax loss harvesting. However, the internal reality of this movement is far more complex. While the retail crowd is watching the daily fluctuations on a Fidelity mobile app or checking their Robinhood stock trading account, the institutional desks are reacting to a specific set of delivery whispers coming out of the Shanghai and Austin factories. The expectation is that Tesla will coast into 2026 on the back of its high-margin software promises. But the reality is that the core automotive business is facing a significant test of its scale. The curiosity here does not lie in the 1% drop itself, but in the massive volume underlying it. We are seeing institutional blocks moving in a way that suggests a rotation. While Nvidia stock has been the darling of the AI trade for months, Tesla stock is being re-evaluated not just as a car company, but as a robotics entity that still has to pay the bills by selling pieces of sheet metal and lithium. If you look at the recent data from Interactive Brokers trading platforms, the buy-sell spread for TSLA has widened, indicating that the market is struggling to price in the conflicting signals between the high-flying robotaxi narrative and the grounded reality of slowing delivery growth in Western markets. The expectation was that the Cybertruck would be the primary growth driver by now, but the reality shows a more measured ramp that hasn't yet offset the cooling demand for the aging Model 3 and Model Y platforms. When you sit down to think about your personal investment strategy, whether you are using Schwab Intelligent Portfolios or managing an individual brokerage account at Fidelity, you have to look past the headlines. The common belief is that Tesla is untouchable because of its lead in charging infrastructure and data collection. The contrarian view, which is gaining traction among those who use Interactive Brokers platform for deep technical analysis, is that Tesla is currently caught in a valuation trap. With a price-to-earnings ratio sitting comfortably above 300, the market is pricing in perfection for a company that is currently seeing its automotive gross margins, excluding regulatory credits, compressed toward the 14% mark. This creates a massive tension. The narrative says Tesla is an AI powerhouse, but the balance sheet shows a company that still relies on the physical production of vehicles to sustain its massive R&D spending on things like the Optimus robot and the Cybercab. Recent stock movement has been dictated by a tug-of-war between retail optimism on the Robinhood app and institutional caution. Over the last few sessions, we have seen Tesla stock attempt to break through the $500 resistance level, only to be pushed back by heavy selling pressure every time it gets close. This suggests that while the individual investor is keen on self-investing and buying the dip, the larger funds, the ones you see in Fidelity mutual funds or large Fidelity ETFs, are taking a more tactical approach. They are looking at the macroeconomic pressures, specifically the rising cost of consumer credit, which makes a $70,000 electric truck a harder sell than it was 2 years ago. Even with the availability of Robinhood fractional shares making it easier for anyone to participate in online investing, the sheer weight of institutional selling can overwhelm retail enthusiasm in a heartbeat. If you're currently navigating the world of online investment through investing sites or seeking investment help from a SoFi robo-advisor, you've likely noticed that Tesla's volatility is its most consistent feature. This volatility is not random. It is the market trying to reconcile the gap between Elon Musk's ambitious timelines for unsupervised full self-driving and the actual regulatory hurdles being faced in states like California and Texas. The recent release of FSD version 13 was expected to be the final hurdle, but the reality is that the system still requires a level of human oversight that prevents it from being the purely passive income stream that many bulls had hoped for. This is where the friction lies. Investors using a SoFi trading platform or interactive brokers' stock trading tools are seeing that the take rate for the full self-driving package hasn't spiked as sharply as the bulls predicted, which puts more pressure on the hardware sales to carry the valuation. The institutional activity over the past week shows a notable shift. We're seeing a decrease in the number of long-only funds holding the stock, while the put-to-call ratio has started to lean more defensive. Those using Fidelity brokerage services or looking at their Fidelity wealth management reports might see that Tesla remains a top holding, but the weightings are being trimmed. This is a classic example of expectation versus reality. The expectation was that by the end of 2025, Tesla would be producing a sub-$25,000 vehicle in high volumes. The reality is that Project Redwood, or the so-called Model 2, is still in the pilot production phase, with meaningful contributions to the bottom line not expected until late 2026. In the meantime, the company is leaning heavily on its energy storage business, which saw revenues double this past quarter, providing a much-needed cushion for the tighter automotive margins. Tesla's business model is a fascinating study in vertical integration. They don't just build cars, they own the software, the charging network, and increasingly the battery chemistry. This is why many people who engage in active investing via SoFi Active Investing or manage their own Fidelity IRAs are drawn to the stock. It feels like a bet on the entire future of energy and transport. However, past performance shows that Tesla often goes through long periods of dead money, where the stock price stays flat or declines while the company builds out the next phase of its infrastructure. We saw this between 2017 and 2019, and we might be seeing a repeat of that cycle now. The older reports from 2024 showed a dip in net income as the company shifted focus towards AI, and the 2025 figures are confirming that this transition is expensive. For those using Robinhood Crypto or Robinhood Cash Management to diversify, the link between Tesla and the broader tech sector is clear. When Nvidia stock moves, Tesla stock often follows, as they are both viewed through the lens of high-growth technology. But unlike a pure software play, Tesla has to deal with the messy reality of global supply chains and manufacturing. The recent expansion of the Nevada Gigafactory and the ongoing tweaks at Giga Berlin are essential for long-term health, but in the short term, they represent massive capital expenditures that weigh on free cash flow. If you're looking for the best investing sites to track this, you'll see that the consensus among analysts is becoming more divided. Some see a clear path to a $2 trillion valuation based on robotics, while others point to the intensifying competition from Chinese manufacturers who are operating with much lower cost structures. I want to pause here for a second because I want to hear from you. Comment below with how many shares of Tesla stock you currently hold in your portfolio, and tell me if you are buying more at these levels or if you are waiting for a deeper pullback before you commit more capital. Your perspective on the ground as an investor is often just as valuable as the data coming off an interactive broker's account. Looking toward the future, the outlook for Tesla depends entirely on two catalysts: the successful ramp of the affordable platform and the regulatory green light for unsupervised ride-hailing. The expectation is that the Austin pilot for the Cybercab will lead to a nationwide rollout by next summer. The reality is that each city presents a unique set of legal and environmental challenges that could delay this for years. If the timeline slips, the stock could see a significant re-rating as investors lose patience with the AI narrative and start valuing it more like a traditional, albeit high-tech, automaker. This is the risk of self-investing in high-beta stocks. The swings are driven as much by sentiment as they are by quarterly earnings. In summary, the movement we are seeing in Tesla stock today is a reflection of a market that is deeply conflicted. On one hand, you have the promise of a world where Tesla robots and autonomous cars generate trillions in value, a vision that keeps people logged into their Robinhood investments or SoFi investing apps every morning. On the other hand, you have the reality of a $480 stock price that demands massive near-term growth in an environment where consumers are increasingly price-sensitive. The tension between the expectation of a software-driven future and the reality of a hardware-constrained present is what creates the opportunity and the danger. As you look at your own individual brokerage or consider the advice from Fidelity Wealth Management, remember that Tesla has always been a company that defies conventional wisdom. But defiance comes with a cost, and that cost is